Hello and welcome to Talking Point. Joining me on the show is Rahul Bhasin, Managing Partner at Bearing Private Equity Partners. The case for a chat of talking to Mr. Bhasin, well, there could be multiple ways or multiple conversation points, but to my mind today, would love to understand from him what is the private equity view on India as at the start of the calendar year and how he thinks about calendar year 24. Also talk about whether valuations can expand further, because in the private markets, as in the public markets, the valuations have really soared in select pockets, of course. And what are the spheres of growth, according to him, within this Indian landscape? Rahul, so good having you. It's been a while. Thanks for taking the time out and speaking to us.
My pleasure. Good to see you guys are trying to revive your channel. It's great. Wish you the best of luck for that.
Thank you so much. 2 months or 2.5 months and counting, Rahul. I'm glad that we're talking at least now. But would love to understand, Rahul, at the start of, virtually the start of the calendar, though we are about a couple of months into the year already, how do you see the landscape for investing both private markets as well as some of the public market investing that you would be doing?
Look, I think, all your guests would have articulated. I think India has been in a sweet spot in terms of macroeconomics. I think the balance sheets of the government, the balance sheets of the banks, the balance sheets of the corporates are all in very good shape. And I think that's a recipe for sort of ongoing growth. You also have a situation where I think the real estate cycle, which started after the global financial crisis, and then showed some false starts in 2016, 18, 20, and then got sort of knocked down again during COVID. You're seeing a very strong revival in that, and post the RERA cleanup, etc. And I think that has a lot of multiplier impacts. So high capex by the government, good balance sheets, revival of the the entire real estate sector, and also the entire push of the government towards the early stage businesses, the disruptive technologies, and the very vital linkage of industry with academia that one has seen, to my mind, bodes very well for an ongoing resurgence and a sort of great macroeconomic environment for a long time to come. I think the real challenge is that if you look at it, a lot of this is already well understood, and a lot of this is in the pricing, which is why, in terms of multiples, we're probably amongst the highest in the world. We're, probably 23, 24 times earnings as a market as a whole. And on top of that, you have a situation where, high multiples, but you also have a lot of high uncertainty in the world. We all extrapolate sort of earnings and sort of value businesses on the basis of an environment that we know and understand. But geopolitics is changing rapidly. I mean, and that can throw up curveballs from all kinds of places. And the way trade works, the globally integrated supply chains can have disruptions. There are also issues around the fact that there is this huge cascade of debt, which is there in most developed markets, especially in the US. And also there are a lot of risks about which also abound. So I just think that from a macro perspective, it's not an easy one-shot call that this is a one-way bet. I think one has got to look ground up and sort of be certain that what you're investing in and how you're investing makes sense. You talked about valuations in the private markets. Private markets tend to be very fad-driven, much more than the public markets, very strangely. One would expect that, when a market more driven by institutional players would not see that, but human beings are human beings at the end of the day. So whatever becomes fashionable tends to become overvalued. But you've got to look at the areas which are not so fashionable, but which afford a significant amount of growth. And I think the very strange thing that I see is that when you've had zero cost of capital from 2008 till virtually about 3 years ago, that whole period engendered a lot of disruption, a lot of investment in core technologies, etc. And a lot of the impact of that in terms of disruption to whether it's in the public markets or the private markets, one will see. And I think that that impact has not been felt fully. That will play out over the next 5, 7 years going forward. And I think that that will again, it will create new winners and losers. So I think my basic point is that the landscape is evolving and changing quickly, and one has to sort of be on top of that entire disruptive landscape to be able to make any kind of reasonable long-term bets.
Wow. Rahul, you've given me a chance to ask you 3 follow-up questions on the basis of your opening answer. I'm going to save the question around the linkage of industry with academia for the last. I'm going to start off with something that you mentioned around the certainty or geopolitical certainty or political continuity, policy continuity in India, but also the fact that the newer normal of higher rates brings about a period of multiples coming off. So from a private market investor, both in India, a large player like yourself, or your peers around the world who invest into India, right? I'm trying to think about the Indian landscape right now and not necessarily the world. How do people juxtapose both of these? That yes, there is policy continuity probable in India versus the rest of the larger markets, and therefore maybe let's go for India. But at the same time, the new normal is different because rates are higher, multiples technically should be lower. Do we still pay a fat premium to Indian startups, Indian private markets, or Indian public markets?
I think, now let me address this since you alluded to the private markets. Let me address this first from that context. You know, private equity is a sort of all-encompassing word, and it's like using the word manufacturing. In the most of the developed markets, private equity is largely a financial engineering product, and as a consequence of that, there's often high use of leverage. And when you have high use of leverage, when rates go up, I think the impact on the overall equity value tends to change a lot more. In India, the private equity is largely facilitation of growth. So it's very different kind of market. It's not a financial engineering product. It's much more about catalyst and an enabling as a part of an ecosystem to enable accelerated growth um, in new businesses. I think that's really the difference, and therefore the impact in India. Indian private equity will be much less than it is in the West or in the areas where one tends to use a lot of leverage. That's almost absent in the Indian context, and therefore the impact is much more muted. Having said that, ultimately, if rates are higher, that's the discounting mechanism. Of course, it'll pull the value of all asset prices down, and quite rightly so.
Okay. Okay. So you reckon that despite asset prices rightfully at some point of time coming lower or in certain cases coming lower, the interest around policy continuity could still help flows into India, both in private markets and public markets?
I think India is in a sweet spot, and I think India will continue to stay in a sweet spot. I don't think that that's changing in a hurry. But the reality is that, you know, if one looks, forget the Indian ecosystem. I think the Indian ecosystem has seen very rapid change in the financial saving mix. If you think about it, as recently as 3 years ago, um, only 2% of financial savings went into mutual funds. That numbers jumped to 6. Now, you know, is 6% of financial savings right for the mutual fund industry or for equity allocation? I don't think so, especially in a younger country like ours. Maybe that number should be much higher, but these changes tend to happen much more gradually. So I think you might have some leveling off as far as that is concerned. 2 to 6 is a big jump, right? The second thing, according to me, is that 35% of the free float in Indian markets is still held by FIIs. And I think the issues and challenges in the overseas markets are still very high. And as a consequence of that, you might get volatility. And I think the biggest direct concern for an Indian context is the fact that if you look at the US, See, the US, adopted this zero rate policy, easy monetary policy, loose fiscal policy kind of after the global financial crisis. But about 4 or 5 years ago, they changed tack and they've gone to tighter monetary policy and looser fiscal policy. Now, the problem is that the aggregate debt is so high that they have to keep on borrowing more and more, and it's actually widening the fiscal even more. So it's become what I call an unstable equilibrium. And the big challenge is that a lot of that borrowing is actually happening in very short term money by the US. I think that once that mix were to change a little bit, you might actually have a situation, a strained situation, even if they lower rates. The long end of the curve might steepen, and as a consequence of that, that's typically the benchmark with which you sort of add an equity risk premium. I think you might have a lot of cost of capital increase worldwide, and you might have outflows from India. Now, remember that we are the most expensive market in the world, so we are that much more vulnerable. I mean, we are one place where people are making money, so the probability that they might pull out more is higher, and that risk is something which is a reality that we have to live with.
You mentioned about how the changing landscape of correct me if I'm wrong, but I guess that's what you were trying to say, that higher than normal interest rates relative to the past 15 years would create a completely different set of winners and losers relative to what they would have been in the past decade, if you will. Could you elaborate a bit on that point?
It's not just rates. I think the real issue is the fact the point I made about the almost zero cost of capital for a period of 12 or 13 years in the world economy. I think that's been unprecedented. You juxtapose that with the fact that you have more engineers and scientists living and working together than you've had cumulatively in the history of mankind. Um, I think that those two things together is going to lead to a lot of disruption. The way disruption works and the way it happens is that you end up with two kinds of disruptions. You end up with the incremental disruptions, which means making something a little more efficient, a little cheaper, a little better, or more productive at a certain price point. And usually the incumbents tend to win those games. And then there is what I call the disruptive sort of the disruptive change, which is really a new way of doing things and a new sort of understanding. And that usually the incumbents, because they're protecting their old turf and protecting their old capital assets and trying to, enhance that return on capital employed there, they tend to miss out on. And I think that the frequency with which you will see these disruptive part will be much more, at least for the next decade or so. And that's the now a lot of this also comes from understanding. So let me take one example. I mean, one of the things that we lead our daily lives and we sort of aspire to growth, and a lot of growth has been, the aspiration has been to sort of get the standard of living in the West, and I think that that's a great aspiration as far as the country is concerned. But what's also becoming apparent is that it's not sustainable, and is not sustainable in many ways. I mean, let's take agriculture, for example. Um, if you look at agriculture, the sort of model which has been followed around the world is shove a lot of fertilizer on the soil, use sort of high yielding crops, use monoculture, systematize, and grow plants at scale. Now it's becoming apparent that that depletes the soil. It kills the earthworms and the natural organisms which make the earth, the earth more fertile. And over a period of time, it actually destroys your ability to grow crop in that area at all. Now, then came the incremental innovation, which said that, what, instead of using fertilizer, let me use nano fertilizer so that the efficacy of absorption of nutrients is higher. And, therefore you'll use less fertilizer and, the agriculture will be therefore better. But then there's the next level of disruption. And the next level of disruption is that, what? Why do I need to use fertilizer at all? Why don't I use natural microorganisms and I can epigenetically modify them to fix more nitrogen in the soil and more phosphorus in the soil, etc., and release those microorganisms in small capsules, which would then do the same job but not kill the ecosystem of the earthworms, etc., not deplete the soil. So I'm saying, you have multiple layers of technology. Now, does this happen overnight? It doesn't. But there's a clear path in understanding where this will go as the understanding around this keeps evolving and changing, right? Similarly, when we look at things, we tend to look at it from what I call a political economy only. Whether you look at this agitation on MSPs, etc. But if you look at it you sort of add on the sustainability oversight on it, you know that in places like Punjab, etc., the water table is falling every year, and you know that this method of subsidizing and giving MSPs and cash crops which use a lot of water is not sustainable, which means that the whole ecosystem has to change. So there are new winners, new losers, and I think I'm just sort of pointing that out as an example of how in every industry this same kind of paradigm is playing itself out. The most well-known example probably is this whole movement from IC engines to EV engines and the challenges around that. But you will see this everywhere. I think the one other big place where this is inevitable and likely to play out is in energy. No civilization um, can work or evolve without a lot of energy, which is not from us as human beings, right? If you look at the amount of energy we consume, and over the last 200 years, which is really where the humankind has had the most development, our consumption of energy has gone up considerably. And it makes sense. So it's not that we are going to go back to a situation where we don't have energy. So I think clean energy is going to become more and more vital. And at least to me, it's very apparent that solar wind will play its part,
Right.
but nuclear will have to be part of that solution. And then there is the entire value chain around that, which gives you good investment opportunities. And there's an entire value chain which gets destroyed. So that's another kind of example in terms of how to think about some of these things.
Got it. Got it. Rahul, would have loved to talk more because I was really intrigued by the industry and academia linkage, but maybe we'll have to save that for another time because we're completely out of time on this leg of Talking Point. But thank you for taking the time out and being with us today on the show, and looking forward to talking to you more often.
My pleasure.
All right, that's the view from Bearings PE, and I think the last part that he mentioned was interesting. The value chain development and the destruction or delinking due to changes is something around many spheres that people need to watch out for. We need to wrap up this edition of Talking Point. Thanks for tuning in. Stay tuned to NDTV Profit.